Hi, welcome to Ventura. In the next few minutes, we're going to tell you what a bull put spread is and when you should try to employ it. Then we'll tell you what it exactly involves, what you can expect to gain or lose if the stock moves as per or against your expectations, and finally, we'll run you through a practical numerical example to illustrate the concept, and then quickly review the same as well. As the name suggests, it's a bull market strategy, which basically means you expect the markets to go up. It involves purchasing and selling of puts, and since it involves both purchasing and selling of puts, it creates a spread. Now, when should you apply a bull put spread strategy? The most essential condition, as you may have figured out by now, is that you expect the markets to go up a little. You must be marginally bullish about the market. Another important condition is that you expect the market not to move too much until your options expire. Here's what you need to do to create a bull put spread. You purchase a put option on a particular stock at a relatively low strike price, and simultaneously you sell a put option with a higher strike price on the same underlying stock with the same expiration date. Now, what's the rationale for a bull put spread? You earn a premium credit as the cost of the put that you sell is higher than the one you actually buy. You do expect the markets to go up marginally, but you would like to limit your loss if it doesn't. Overall, you limit your potential losses at the cost of limiting your profit if your views are correct. As we've explained before, both your risk and return in a bull put spread are limited. The maximum risk is limited to the difference between the strike prices less the premium that you earn. You face a risk if the price on maturity somehow falls to or below the strike price of the option that you have purchased. The maximum reward is limited to the net premium that you've earned. This will happen when the price at maturity is above the higher strike price. Here's an example to make the strategy really clear. Let's assume the Nifty current month future is at 6,000 and you feel it will close at 6,200 at maturity. You could set up a bull put spread by buying one lot at a strike price of 6,000 and simultaneously selling another lot at a higher strike price of 6,200. This strategy will earn you 150 rupees, which is your net premium receivable. This is what your payoff graph will look like. If the strike price rises to 6,200 or goes beyond, your payoff will be 150, which is basically your net premium that you have received. If somehow the strike price remains at 6,000 or falls, you lose the difference between the two strike prices, that is 200, less your net premium which you have received of 150. So your effective loss is only 50. Anything in between the two strike prices will give you a return between the maximum and the minimum. Let's take a look at the numbers behind the graph. As you can see, your break even is at 6050, which is nothing but the highest strike minus the cost of spread. As you can see, any move above 6050 will ensure you start making a profit up to 6200. Thereafter, your profit remains stagnant at 150, which is your net premium receivable. And below 6050, you make a loss up to 6,000. If Nifty moves below that, your maximum loss is not effective as it stagnates at 50. Now let's summarize our example. The cost of spread is 150, which is the net premium received. The spread range is the highest strike minus the lower strike, which is 6,200 minus 6,000, which is 200. The maximum loss is 50 rupees, which is the spread range minus the cost of spread. The maximum profit is 150, which is basically the net premium received. The break-even point is 6050, which is the highest strike minus the cost of spread. Now, while you may be clear about the reason for structuring a bull put spread, which is basically the expectation that the stock or index will rise marginally, remember that it is time to exit this strategy when the market crosses the highest strike option, the one you sold, and seems likely to fall again before maturity. Let's take a quick recap of this strategy. A bull put spread is a bullish strategy. It can be applied to a market, index, or stock that is expected to rise marginally. It limits your risk, but limits your return potential as well. So, in a nutshell, it's a strategy for traders with a low risk profile. Thank you for viewing our presentation.